The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour right here on TFNN. Make sure you listen to us anywhere on your mobile phone on tfnn.mobi and watch Tiger TV right there on the site. Let's check out where everything is at right now. Right now, we got the indices just sort of fluctuating a little bit right there around settlement. We got S&P is down 4 points. We got NASDAQ up a quarter. We got Russell's down 5 points, and the Dow's down 20. So not getting those triple-digit days on the Dow right now. We got gold currently down 33. That's right. 33 points on the day. We got silver down 0.952. We got copper's down 0.049. We got oil up $1.25. We have natural gas up 0.074. We got corn is up 10 points on the day, and soybeans up 26. Got some big moves right there on the soybeans, especially with the ag reports that just got released, the WSD ag reports. WSDE waged, whatever. And we got euro dollar flat on the day, up a tick. We got pound dollar down 5. We got Aussie dollar down 63, getting slammed last night after the bad employment change and unemployment rate report that came on out. We'll go over that here in a moment. We got euro yen currently down 85 pips. We got pound yen down $1.04. And let's see, U.S. yen is down 62. We got dollar CAD is currently up 3, and dollar franc is down 11 on the day. So, like I said, the Aussie dollar got slammed. Let's go in and let's look at it. We'll look at Aussie dollar, we'll look at corn, we'll look at soybeans, and maybe even we'll go in and check out, see if we got a good gold trade going on for today. But looking at the Aussie dollar and pulling it on back to last night, you can see we got that nice big move and testing that thing on down to the lows right here. Got a solid 89, 90 pip move, if I get it just accurate there, 90 pips to the low on that report. So nice, solid move on Aussie dollar. And if you're looking at it, one thing, there's a few things you need to be looking at when you're looking at these reports. And there's multiple websites you can look at, investing.com, Forex Factory, etc., for whenever the reports come out. But so let's just go ahead and take a sneak peek and look at the results on that trade. I usually don't like Forex Factory, even though it's a cool site. It usually just gets overwhelmed and basically becomes useless. But what do you need to be looking at? Well, we had some expectations. I was hoping we were getting more of a negative 14. We didn't get the negative 14, but what did we get? What would have given you the, reason to stay in the trade? Well, first thing is I usually try to give it at least 5 minutes or so. Ideally 10 minutes before I'm going to hop out of the trade. But I want to look at the expectations on the report, and the expectations definitely did not give us what we were, hoping for. On the expectations, we were hoping for, like I said, a negative 14.8 or a positive 35.2. We didn't get that, so should you have had any confidence to stay in this trade? Well, we had 3 negative things happen. The unemployment rate met expectations, but it ticked higher. So higher unemployment went from 5.7 to 5.8%. So that is it. Even though that's at expectations, that's a negative thing. We also had the employment change come in at a negative 10.8 versus an expectation of 10.2. Okay? And let's look at this unemployment thing, because there's a third thing that is so often overlooked that it's easy to miss. Okay? Last time the employment change, changing the number of employed people, came out, it came in at a negative 10.2 thousand, but they revised the number down to a negative 11.4, and the market's been really reactive lately to the revised numbers. So not only was last week's number way worse than expected, because they thought it was going to be a positive number, 6.2 thousand, it came in last month as negative 10.2, and then they said, oh, sorry, it was actually even worse than we thought. It was negative 11.4. And so that gave 3 signs of negativity. You had a negative employment change, or actually 4, negative employment change, worse than expected. They thought it was going to be 10.2. It was negative 10.8. And so, you got a massive, worse than expected number. But then also you got a revision down, and you had unemployment rate, even though at expectations, lower than last time. So 3 major things. You could say 4, total, I guess. So worse than expected and, just negative numbers across the board. So all bad things for the Aussie. The Aussie reacted accordingly. It fell on down. And what I told you yesterday and I told you this week on the Aussie dollar was that 75% of the time the Aussie dollar moves 50 pips when this report comes out. This was our main trade for the week. And 50 pips came out, sort of my news pick of the week out of all the news trades. There wasn't that many. And but I also said the average move is about 50 pips, and we want a risk of about $35 on the trade. One trader actually sent over their trade, and they went in, and Mark got in a $19 risk without about a 10, 15 pip either way to break even. So he got the combined risk right there. Make that a little larger for you. There we go. Maybe that's a little bit too large. There we go. $19 on the trade. So definitely well under that 35. And he hopped in early, like right around 8 o'clock or so. Well, how could he do that? The report didn't come out until 9:30. He hopped in at 8. This is an 11 o'clock expiration. So he could use the 11 p.m. expiration. He found a great straddle within the risk requirements. He's able to put it on early, walk away, didn't have to worry about it until the report comes out at 9:30. So he had an hour and a half, a downtime, came on back, report comes out, starts moving. Now, again, the expectations weren't that far off, so, could have hopped out at break even on the trade, no problem. But the first 5 minutes, we didn't really see a whole lot happen. So it'd be very easy to put that in at break even. But again, just noticing all those negative things, worse unemployment, worse than expected unemployment change, and then revision down on the previous unemployment change could have given you confidence to give it like 5 more minutes. If you would have given it just 5 more minutes, maybe not even that much, then you easily would have got out right about here, around this deviation level, this half deviation level. That would have popped you out of the trade, and you would have got your 1-to-1 on it. All right, so what else did we have that came out that we can, or what else is coming out? So both of those questions there. And I'll go in, I'll look at those for you. We'll put the pieces together. And we have another report coming out tomorrow that you could potentially take advantage of. I've not been impressed with looking at the most recent reports. So I'm going to tell you right now, if you're going to trade this one, my suggestion would probably be trade it light because it hasn't been moving like crazy lately. And let's see, let me pull that report up. I'll give you the details here in just a second. And the report coming up tomorrow, it's going to be tomorrow morning between 8 and 10. The report comes out at 8:30. It's going to be on the dollar. There we got a dollar core retail sales coming out with core retail sales. And we're also going to have core PPI. And, so we have 4 reports. We have PPI, core PPI, retail sales, and core retail sales all being released at the same time. Last time all 4 of these came out was on April 12th, and we only got about a 40 pip move. So definitely try to keep that risk low. I'll give you the stats on it, but again, I would probably keep my risk even lower than the stats just because of the lack of movement we've seen that's been impressive lately. And the stats on it, the euro dollar, 70% of the time does move 50 pips or more with an average high to low of 62 over the last 2 years. And so the max risk would be about $41 on that trade on the euro dollar. It really would be more the preferred trade to straddle. And then as far as doing maybe a binary butterfly into, not after, but into the news for like a 10 o'clock expiration, you could look at the dollar yen. It's only broke 50 pips 16% of the time. And average high to low is actually 49 pips. So it's definitely under that 50 pip range. If you could get a nice, maybe wide potentially, dollar CAD to maybe do a binary strangle and then do a straddle on the euro dollar, that might be an ideal setup. But that's really, the main stuff we've had. And we had, of course, Draghi came out. He had a little speech this morning as well. We can look at the impact on that. I told everybody, be aware, he is talking at 7:40, and you never know what's going to come out of the man's mouth, and it can cause some volatility. So he starts talking right here, and as you can see, there was definitely some movement off of Draghi talking. I said, expect, between a 20 and 80 pip move on his speech. We got about 40 pips, so almost there in the center. And then it bounced on back up. So from low to high, we got a big move, basically a deviation there. Got 69 pips, maybe a little bit more, but about 69 pips there from low to high on the euro dollar. So Draghi did his normal thing, right? So, and you see this spike. This is your clue that the move was done, by the way. Just a good analysis for you. When you see a spike like this after a trend down, that doesn't mean breakout, okay? Especially when you see a big pullback on that bar. What that means is they're dumping off their orders. They're buying back. And so expect a major, pullback, at least a 50%. And since you got more than a 50% pullback on that bar, I mean, look at this thing. That's a reversal bar just begging to go the other direction. That thing pulls back. You better be tightening your stops, and don't be surprised if you see it go the other way. And that volume bar alone, very, very helpful. You also get to check that out over on the euro dollar. And let me pull that up. You'll see it popped on down, went on back up. And you have the same volume spike with true volume, because when you're looking at euro dollar spot, you're only seeing tick volume, which is how many times it changed price. But that's actual contract volume there on the euro dollar. With that, let's go ahead. Let's see if we might see anything over on gold, and see if we see any trade. And then we'll hop over, and the focus today that we really wanted to do was to look at maybe go over a little bit over hedge trades and just do sort of a quick summary on what is a hedge trade for you futures and forex traders out there that you might like to take advantage of. But before we hop into hedge trading, let's hop into our metal expiration trade here. Happens every day at this time. And let's see here. Got some just random demo trades I was doing earlier in the day. And let's see, I'll cancel that thing out. We'll cancel it. And let's close that because that's just demo trades there. Close that out. There we go. Okay. Try again. Okay, we'll try again. Once it pops up, and there we go. Okay. So we got that resolved, and the next thing is we'll go down here and look at gold and silver. We do not have a gold trade currently for the expiration premium collection trades. These are usually anywhere between 15 and 3 minutes, 3 and 15 minutes, I guess you could say. We do have a potential silver lineup, so I'll pull up a silver chart, and we'll see if we got that on there. Let me go ahead and click on the ticket to open it up. Look at it. We are getting, looks like a little bit of a pull there, but give me 1 second. I want to get the details and see if it really looks like a trade that is worth potentially risking money on. Okay, so we got silver. And we are trending down a little bit right now at the moment. So it could be a good trade. It's at 22.2, but 22.175. That's not really far. That's only a few ticks. That's 5 ticks. That's our minimum tick range. So I'm going to be hesitant on this one. It probably will work out to be a great trade since I am hesitant. But I don't like the distance on that trade. Looks like we might have a gold trade that might want to pop up for us here in a little bit. There we go. Pull that one up as well. And so now we got these 2 potential trades. We'll just lock both of those in right there. And we'll check them out when we get back from this break. Stay right there.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors.
TFNN is having an open house in the Tiger's Den for 2 weeks, and the best part is that everyone is invited and you just have to be a member at TFNN. The open house in the Tiger's Den has already begun and will last through our week-long virtual trading competition, which ends September 13th. Use this time to exchange trading ideas with other traders in the virtual chat room and to discuss trading strategy. For all the information and to take part in the Tiger's Den open house, log on to TFNN.com today. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, we're going back here to the Diagnostic Trading Hour. Except that silver trade did or is about to expire on in the money. Silver flew on down 22.2. Looks like we're at 22.13 right now. We have the gold trade as potential trade. You can get it at $15, $20, $30. But it's got about 10 ticks to go, and it has around 6 minutes on it. So you could take the trade if you wanted to hop in on that. We got about 9, 10 ticks, like I said, left in there. And so we do have a decent amount of room on the trade. And just put in what price you're willing to, actually take the trade for. So say you're willing to take it at 20, then you can put a place order on that. And then boom, got filled on the trade. And the big thing is you got to be ready. Got to be ready to take this thing off if it should go against you. You can even add in, I went in, added another one in at 25, okay? So it's flying around a lot. There's one at 30, and I'm just showing you an example here, of course. But you got to be really careful, because this is what I want to teach you, because this thing is really close, and I'm a little nervous about it personally. That's why you see the words demo instead of live in the account. But let's go up here. This is it's a good learning experience. Like I tell you, demo these things till you really get the feel for them. And so what you can do over here is get ready for the other side. Just go ahead and then click that little X right there inside the scanner. And once you got that going for you, then I want you to go in and put this as a buyback like at 60, okay? Have that ready so you can hop on out of the trade should it go up and hit 1330, which is not that far away. We're only talking like 4 ticks away, okay? So you could hop out right now if you wanted to. I actually see a few orders right there where I could buy them back pretty low. We're really, really close. So this trade's going to have a rough time. It's like somebody went in and just took out the book. But they refilled that. That was nice. I mean, they took out the book. The book was refilled pretty fast. And, of course, we got all these traders going on right now. We're only a tick off. You may be like, you know what? This isn't worth it for me. This isn't worth, risking $70 or whatever. I mean, $75 times 3 contracts. We're too close. I don't like this trade. We just hit 1330, not my trade. What do? Go in, click on the price, get out of the trade, okay? Exit your trade. That's what you want to make sure that you're doing whenever you do these. And if the market moves too fast, then you may have to adjust your order. But just be really, really careful on these. I love the premium collection trades, but you can get steamrolled if you don't do them correctly. And notice I said, hey, we're doing this as a demo. I'm not comfortable with how close this is. I didn't take the silver trade live. I didn't take the gold trade live. And if you're not comfortable with it, the best thing I suggest you do is go over and demo trade it. And just to, learn and see, how the trade's working out, to see how the price moves. Experience is huge on this, and you really, really got to practice in that demo before you go live. And I'll do live trades. I do a lot of live trades on the air. But if they're close, I'm not putting my real money up. It just makes sense. So make sure you look for, the really, really good, the best possible potential setups. And something else I've even done before, and this is, again, I'm demoing all of this, okay? So I've even hopped in, and I'm like, you know what? Things flying up. Maybe I'll go the other direction. So, again, this is really close. So it'd be pretty crazy to be hopping in like crazy on this. But you could go in and, maybe if I want to close those out or whatever, or, buy back there, then I could go in and say, you know what, well, I'll buy a few to make back some of my losses or make back all my losses, depending on how much you put in. And you could go the other direction on the trade. So you could hop in there and flip that trade around. And so, we'll see. That'll get filled here in just a second and be put on up there. But just practice them, okay? Practice, practice, practice. And, by the way, practice does not make perfect. Perfect practice makes perfect, meaning learning how to do the right thing at the right time, knowing when to get out. So that's how this works. And that's just something that you really, really want to be aware of is, how do you get in the trade? How do you get out of the trade? How should you respond to the trade? Right here, we got, $71 as a quote, and it's up. Is it above still? Yeah, see, this would be, I'll take that, okay, because you know what this is? That's somebody who's not paying attention. So you can go and you can get trades that are like in the money already. Some people will have a trade out there just sitting out there for who knows what reason. And you can grab those trades as well and put those on. I'll just cancel this one. I don't need it anymore. So we'll cancel that out. Got 10 contracts in. And so as long as it finishes above 1330. Somebody left. And don't make this mistake. Here's another one you don't want to make. Okay? Don't make this mistake of being the guy who leaves in the money trade, which is basically just asking to lose, okay, right there at the last second, because somebody's going to come along and the sharks, old Jaws, music there, are going to come in and just get you. So be careful. Don't do that, because right there, live account, clean up. You'd make quite a bit of money if you're doing that. And you don't want to be the guy on the other side getting taken advantage of because you don't pay attention to where your orders are in those last 2 minutes. Stay right there. We'll be right back after this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position, for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com. Andy Hecht, the host of the Commodities Hour, recently launched his newsletter service, the Technomental Commodity Report, and only 6 weeks in, Andy has already recorded a triple-digit winner. Andy advised his subscribers to purchase a long-term call option at 46 cents on July 11th, and then sent out a special update Friday, August 16th, advising his subscribers to close that position at $1.40. That's a 204% profit in just 5 weeks. The Technomental Commodity Report by Andy Hecht is released each Thursday morning, and right now you can get a month-long free trial to this subscription while locking in the low introductory rate of only $39 a month. Andy Hecht has been a commodities trader for over 3 decades. Let his experience work for you. Sign up for your month-long free trial to the Technomental Commodity Report today at TFNN.com. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, we'll come on back here to the Diagnostic Trading Hour. So the 1333 able to buy in at 70 did expire in the money. Been bottom, so it expired above 1330. We were able to flip that around. Somebody left those orders out there. Don't be someone that's leaving in the money orders in out there for somebody else to take. You don't want to be that person. All right, so one of the things I talked about yesterday. Oh, before we do that, let's go ahead and knock out soybeans and corn real quick because that wage report came on out. Let's check it out. Let's pull that up, and then we're going to get into sort of intro here on the hedge strategy. The first strategy I developed, still one of my favorite strategies. So we got corn right here, and let me pull up the WASD SE report and go in. 1 second, I'll get that opened on up. And I'll put the link over there for you, USDA.gov. But the official link, stick that in here for you, inside the den. And they go in and they basically list all the reports. And so it's a really helpful place if you want to know where that's at. It'll look at the latest reports, and I'm looking at PDF or whatever, and you can go through and you can review it. You can also look at different things that analyze it for you, depending upon what you're trading. You know, so if you're a cotton trader, livestock trader, sugar trader, corn, soybeans, rice, on down the list, wheat, all that. But no matter what you're trading, you don't know what's going to happen, so you can use something like Nadex to straddle the report. I talked about this earlier in the week, and you go in there and you go in before the report comes out, and when you have that information ready, you could have hopped in about 10. It started moving around 12. So if you chose the end-of-day expirations, and we got just a nice. You see that report. I mean, you know when it came out because you can see just a big bar right there where it moves basically an entire deviation right off of the report. So nice big move on corn, good straddle trade. You also had just a downtrend going on, so you could have done a low if you wanted to. If you could have went with the trend and say, hey, you know what, somebody knows something I don't know, trending down, I'm going to go ahead and go short into this trend. But do it without getting yourself killed by choosing a spread or maybe even a binary to take advantage of it. And also you got the soybeans over on Nadex you could also take advantage of. And we can see right here, the soybeans, and right there about 12:30, just bam, just flying on up. We actually had a bit of a pop before it, and then a little bit more as it moved on up. Let's see, the report came out actually at 12. Sorry about that. At 12. So we got the big move right off at 12, and you had a little time. So you can see you got 11:50, you got 12, it closes out, and then it just goes nuts. So this one would have been counter trend. So if you were going with the trend, you would have got nailed on that one. But if you're using like a spread or a binary, you wouldn't have got nailed. So you could have went short corn and short soybeans, and you would have won on the short corn. You would have lost on the short soybeans. Still could have potentially came out very profitable. If you would have went a straddle on either one, you definitely could have been profitable on that trade. So that doesn't come out that often, but when it does come out, it's definitely worth being aware of. And if you're a corn or soybean trader, you better be aware of it because you can see that kind of move. I mean, you're talking a 46-point move, actually 50-point move right there, pretty much right there on soybeans. And, you know, at $50 a point, you know, it ticks like the S&P, it ticks in quarters at $12.50. So $50 a point, I mean, that's a big move. 50 points, that's $2,500 right there in movement. And if you were short soybeans, you would have got slapped in the face. So, and it would have jumped past your stop. You would have got filled, but it would have been a painful fill on your stop loss. So that's why you might want to do something like Nadex. Now, maybe you want to go directional with it, but you want to have a hedge. Okay? So let's get into this whole hedge idea and what in the world am I talking about? Let's go up here and we're going to look at the spread scanner. Okay? And on the spread scanner, we can go in and we'll choose markets like, you know, corn, soybeans, whatever. And you can go long, go short. So let's say you were going short soybeans, but you wanted to buy. I'm going to get rid of all my filters because there's not that many on corn and soybeans. And let's say I wanted to short soybeans, okay? So we know it went up, but let's just say I wanted to short it. I would then buy a spread, okay? So why would I do that? Well, because I want to hedge my soybean trade. And I actually give you the ratios in here. This is really helpful. I give you the ratios for how many soybeans contracts you need to equal one soybean future. And the ratio in this case is 5 Nadex soybean contracts to 1 soybean future contract. Why is it 5 to 1? How does that work? Well, one soybean contract, it moves in quarters. Every quarter, like 0.25, 0.5, 0.75, 1. Every quarter is worth $12.50. So 4 quarters times $12.50 equals $50. $12.50 times 4. All right, so it's worth $50 a point. Well, on Nadex contracts, every single tick is worth $1. Everything ticks in a decimal of 1. You can see it says up here that the Nadex ticks in 1, and the tick value is 1. So 10 dimes equals $1. Like 4 quarters equals $1. So a 1-point move on a Nadex spread is worth $10. Whereas a 1-point move on a soybean contract is worth $50. So 50 divided by 10 is 5. So you got 5 Nadex soybean contracts to 1 soybean future. If you don't understand all that math, you can go back, review it, ask questions, etc. But bottom line, we've already done all the math for you on all of the Nadex contracts. So that makes it so just one more benefit of using the scanner is having that information at your fingertips. Now, if we go over here and we'll look at this, we'll pull up commodities, we'll go to bull spreads, we'll go to soybeans. We'll look at the, it only has one expiration time a day, so it's a less liquid contract, just like on CME, it's less liquid. And we'll go over here, we'll look at, where were we? Right around 12. So before 12, we were right around 11.50. And we may not even have a great hedge, we'll check. 13.43. Well, there is a 13.40. All right, this is a good lesson for you. One of the things they do is when the contract starts trading, they put it like, what they do is they put it 40 points above, 40 points below, 40 points in between. And let me show you what I mean. We got 1360, okay? It's like right here. We got 1360, and then we're going to go up to, like way up there to, 1400, okay? Bring it up a little bit further. There we go. And then we got it over here, and we're going to go from 1360 down to, whoops, wrong indicator. Right there, down to 1320. And then what they're going to do is they're also going to put one in the middle. They're going to put one that is 1340 to 1380. So 20 points above, 20 points below. Why? Well, this is exactly why. Because what this does for you is if the market moves down a little bit, you can have a low risk, spread. And so there's two ways to have done this trade. One, and let's go in and look at it. Okay, let's open it up. Is either way you're going to want this 1340 to 1380 spread if you're going to hedge. And so we can look at where was this thing priced at, before, say like 30 minutes before the report came out. Okay, so right here around 11, 30 or so, we got movement right there, right around 1345 is where soybeans was at. So if we go over here to say 1130, we're getting 1351. So what are we doing? We'll sort of plot this on here. This would make it where you're getting in right here about 1351. So you do have about 10 points of risk. Okay? So about 10 points of risk on that trade. And I'll put together the exact math for you. But let's just say we get in right around 1351. And then we'll say we went short at 1130 around 1345. So we're going to go long the spread right here. Okay, and we're going to go short the spread right here. So what is our actual risk if we went long the spread, long 5 spreads and short 1 soybean contract? What's our actual risk on this trade? Okay, the actual risk on the trade is the difference between where you buy and where you sell. So if I go in and I sell one contract, being the soybean contract, if I go in and I sell that at 1345, okay, that's where I sold soybean futures. And then I go over here, and we'll do the same thing on corn too. If I go over here and I buy 5, okay, buy 5 of these spreads at 1350. Remember, I need to buy 5 so that way I'm making $50 a point on the spread if I'm losing $50 a point on the soybean contract. What's that difference? That difference on that contract right there would be 5 points. Every point's worth $50. So my max risk going short soybeans before the WSDS report up to the ceiling, okay, would be $250. It'll hedge me. It'll make $50 a point up to that point. And again, it won't help me. It's sort of like if you think about buying like an out of the money put, like $5 below a stock. Okay, for that $5, it's not going to hedge you. All right, but so if you sold at 1345, it's not really going to kick in until where you bought it at. You bought it at 1350, so it's going to start hedging you off at 1350. So you got $5 of risk, $250 of risk. But again, this is also something that can move huge. I mean, this thing moved 40 points. If you only lost $250 on a $1,600 loss, that's pretty nice. Now these are in 2 different accounts. Okay, so very important to understand these are in 2 separate accounts. And so you need to have the money for the drawdown in your futures account while you're making the money over in your Nadex account. So your net loss would be like $250 on this trade, okay? But remember, you're down $1,600 on one and you're up like, say, $1,350 on the other, all right? So that's basically how that trade works if you were to use it as a hedge. Now, I'll show you a hedge on corn. We can go the other way. But let's look at a couple other examples of how you could have traded this. Maybe you went long soybeans. If you went long soybeans and you went and you bought 1350, okay, and it went on up to the ceiling of that to 1380, you would have made 30 points on the trade. You would have made $1,500 net on the trade buying 5 contracts. Not too shabby. What would have been your risk? Okay, so if you were to fade it, you thought it was going to bounce, whatever. So if I went and I bought at 1350 and the floor is 1340. Got 10, so times 50, they've been a $500 risk to go along that trade. So I might not have been comfortable with that. Okay? Now, what if you don't want to have it separated into different accounts? If you don't have two different accounts, you don't want to do like a soybean contract, and you don't want to have like losses in one and profits in another. You want to have them all in the same place. Do you have a different option? Do you have a different choice you can take advantage of? Yes, you could just use the master spread. So instead of using a soybean future, you could use a master spread. And by the way, the cool thing about this is you could do any ratio you wanted. So you wouldn't have to do like 5. You could do just 1. Or you could do 12 or 18 or 30 or whatever. Okay? So you could use the master spread. We'll go over here and look at this. What was the master spread priced at? It was priced right at the same price as soybeans. See that? $13.45. So this master spread, if we draw that on the chart over here, we go in, grab that, and it went from $13.20, so down here, on up to $1,400. So we went short in the same place, long in the same place. We duplicated the same trade, but without having to have the money in both accounts. So you may decide, I don't want to do this on both sides. I just want to have it in one place, okay? I just want to have all my transactions in the same place, so I don't have to worry about net position between two accounts. I have all my money, my wins and my losses in the same account. So you can use the master spread as a way to simulate the trade. Maybe you don't want to put up that much money because you have to put up quite a bit of money to short that contract. Is there another choice? Yes. Again, they call these options for a reason. Okay? So let's get rid of that master spread. You could actually, and I call this making your own spread or synthetic spread, making your own box. So let's say you want to go short, but there's no good short spread without having a lot of risk. Then I could actually sell, let's see here, sell the lower spread, the 1320 to 1360, and this is sort of cool if you get this down. Sell the 1320 to 1360 over here, and let me zoom in on this chart so we can see the price a little more accurately. There we go. And I could have sold that for about $13.50, so not bad, $13.50. And then what was my buy over here? Wait a minute, $11.30. So $13.45. Okay, and $13.50. So basically the same prices as before. So $250 risk, or just a 20, or what would that be? If we had 5 points of risk on one contract, it'd be a $50 risk. So just a $50 risk. Okay, or I could do $250 if I did 5 of them. And so with that trade, I go in and let me show you how this looks, because this has sort of a cool piece to it. You go in here and it's going to be 1320 to 1360. So we're going to have that same 1320 like we had on the master, only goes up to 1360, so less margins required. And I'll make money if it goes down, but I also, if it like flies up, I can make money. So this is sort of like doing a straddle, an in-the-money, a Siamese straddle, where you're doing 2 in-the-money spreads because you're expecting a big move one way or the other. And so since there wasn't really a perfect straddle, I made my own box. I sort of had you could say you had a short expectation, a short slant on the trade, because you'll make money faster on a down move because you're closer to the floor on this trade. So after it moves 5 points below the floor, you'd make money. But if it flies up after 5 points above the ceiling of this spread, it stops losing money. This one makes back all the risk on that trade, and then you get to make profit on the way up. So it's a pretty sweet trade. You start learning how to combine the different pieces together. All right, stay there. We'll be right back after this break, and we'll check out corn.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction funds. To obtain a prospectus or summary prospectus, please contact the Direction funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.6% profit to an incredible 48% profit in just one equity. And all 6 of those winning trades had been initiated no earlier than just the previous month. With the 600th weekly Gold Report issue fast approaching, Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began, and right now you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber, as this volatile gold market provides trading opportunities after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial to the Gold Report today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And checking things out on, now we're looking at corn is doing a hedge. By the way, you can do this on the S&P, on the Russell, on gold, on oil, on Eurodollar, pound dollar, Aussie dollar, on down the list, okay? So I'm just showing you a couple examples based on some big moves today. So let's check this out. What if you got it? Remember, we talked about how we're starting to see this short move here going on in corn, and so you decide about 11:30. I'm going to go ahead and take a short position on corn. I think it's going to fly down on this WSDE report, and but I want to hedge off because who knows? It could be like that soybean report where it goes against you. Well, what do we got right here? We got a, let's see, our closing price here, 11:30. We'll do a 465. Okay, so we got a 465 sell price on corn, 465. And then over here at 11:30, we got a buy. Oh, check that out. So that's the bid. Let's switch it over to be fair. Okay, bid and ask. There we go. All right. So 11:30 right there. We got What's the close? Close is 469. Okay, so we got about the same risk. We got 4 points. So we have about a $40 risk per, or a $200 risk if you're doing corn and 5 corn soybeans. So we're selling at 465. We're buying the spread at 469. Okay, and we go over here, so we'll lock those up on top of the chart. I'm going to grab a little rectangle over here, and we'll draw it on. So right here at 469, we're hedging our position on up to 480. Okay, so we're hedged up to 480. We got a pretty good hedge. We got a 20-point hedge there, and it's only costing us a couple points there. So, and we're selling at 465. And so we're going short, right here. We're going long right over here. Oh, and I need to bring this down a little bit because this thing comes down to 460. So it breaks through here, covers that small risk, a few points. We're able to gather a nice little profit right as it pops on down. So that's one of the possibilities on that trade, will be the 460 to 480. If you win, you decided to go in and go short coin and then buy the spreads to hedge it. You also could have went in and chose the 470 to 450 spread, so you could have went in and just sold. All right, you still would have had capped risk on the trade. And so, talking about 5 points of risk right there. And not bad at all for, hopping into it. I mean, you're talking about a major report that usually moves a lot, and we got about 20 points move on that corn. You could have easily taken that off and captured 15 points of profit. That would have been a $750 profit on that trade. And so there's a lot of different ways to put together. I just want to open your eyes to the ability to hedge off a trade. You can do the same thing, like I said, over on the Aussie dollar, on the S&P. Take your pick. All right? And you can go in and just knock it out of the park. But I want you to see that there's more than one way to trade it. You can use it to hedge your futures and forex trades if you're you're a day trader. Maybe you're a longer term trader. You can use these to hedge. The actual cost is lower than it is strictly on the CME to go in and use these instead of using. Now, of course, you got to look at it. Make sure the cost is at that time is lower. But generally, the cost is lower to do these trades than it would be if you were just trying to go in and do a CME option. Because why? Why would it be less? Well, anyway, you're paying for 5 days of premium that's dramatically getting reduced. When's the premium the least expensive? Right before expiration. So you could go in and you could get this hedge on each day and put it on at a very, very low risk, and then just reopen it the next day over and over. Now, of course, you have that difference between open and close that could get you. So you want to get ones that, that's more of an S&P thing where it closes at 415 and opens back up at 6. Hopefully you picked up a couple new things today, and I hope you all have a great trading day. I will see you tomorrow right here on the Diagnostic Trading Hour. Stay tuned for another great show coming up after this.